If you own a home in Minnesota, this might be the most important video you watch today because local governments are proposing nearly $1 billion in new property taxes, and most homeowners have no idea what's coming. We're talking about a massive, coordinated increase in property taxes across Minnesota municipalities that could directly impact your monthly housing costs, your home's value, and your long-term financial planning. This isn't speculation or hypothetical. This is happening right now. Local governments are making these proposals, and the timeline is moving faster than most people realize. So in this video, we're going to break down exactly what is happening, why it is happening, how much it's actually going to cost you as a homeowner, which areas are hit hardest, what this means for home values, and most importantly, what you can actually do about it as a Minnesota homeowner. Let's start with the basic facts. Local governments across Minnesota cities, counties, school districts, and other public entities are facing budget pressures. They have obligations: maintain roads, run police departments, fund schools, maintain parks and public facilities. These costs have gone up. Inflation has increased the cost of everything from road materials to employee salaries to utility bills. Meanwhile, their revenue sources haven't kept pace. Some of that revenue comes from property taxes. So to balance budgets and fund essential services, local governments are proposing property tax increases. The aggregate amount of these increases across Minnesota is approaching $1 billion annually. That's not a typo. That's $1 billion in new property taxes being proposed or considered by Minnesota municipalities. Now here's what's important to understand. Property taxes in Minnesota are not set by the state government. They're set by local governments, cities, townships, counties, school boards, and special districts. Each municipality makes its own decisions about tax rates. But when you add all of them up, all the cities proposing increases, all the school districts proposing increases, all the counties proposing increases, you get to approximately $1 billion in total new tax burden being proposed. This is significant because it represents a meaningful shift in how much Minnesota homeowners will pay. Let's translate that $1 billion into actual numbers that matter to you as an individual homeowner. First, you need to understand how property taxes work in Minnesota. Your property tax bill is based on your home's assessed value multiplied by the tax rate set by your municipality. So if your home is assessed at $300,000 and your municipality's tax rate is 1.0%, your annual property tax is $3,000. If your municipality raises the tax rate from 1.0% to 1.1%, your tax bill increases from $3,000 to $3,300. That's an extra $300 per year, or $25 per month. Now, the $1 billion in proposed increases spread across Minnesota's approximately 1.1 million residential properties means an average increase of roughly $900 per homeowner per year if spread evenly. But here's the important caveat. It's not spread evenly. Some municipalities are proposing massive increases. Others are proposing modest increases. Some are proposing no increase. The actual impact on your taxes depends entirely on where you live. Let's look at specific areas because this is where the real story becomes clear. Minneapolis and St. Paul have been particularly aggressive with tax increase proposals. Minneapolis has proposed significant increases to fund city operations, public safety, and infrastructure maintenance. The Twin Cities metro area, broadly including suburbs like Edina, Minnetonka, Bloomington, St. Paul, and surrounding communities, has seen municipalities propose increases ranging from 2% to 8% above inflation. For a homeowner with a $400,000 home in one of these areas paying roughly $4,000 per year in property taxes, a 5% increase means an extra $200 per year. A homeowner with a $500,000 home would see an extra $250 per year. On a $600,000 home, it's $300 per year. Now multiply that across potentially 20 to 30 years of homeownership, and we're talking about $6,000 to $9,000 in additional property taxes that weren't in the original financial calculation when the homeowner bought the property. Greater Minnesota areas outside the Twin Cities has been hit with increases as well. Rochester, Duluth, St. Cloud, and other regional centers have proposed tax increases. Rural counties have proposed increases. The increases are less dramatic in percentage terms in some of these areas because property values are lower, so the absolute dollar amount per household is somewhat smaller. But in percentage terms, the pain is similar. A homeowner in Rochester with a $250,000 home might see a $150 $200 annual tax increase, which on their smaller assessed value is actually a meaningful percentage increase. So here's what's really important. The $1 billion increase isn't evenly distributed. Some homeowners are paying an extra $500, $800 per year. Others are paying an extra $150, $300 per year. Your actual impact depends on your specific municipality and your property value. But across Minnesota, homeowners are being hit with meaningful property tax increases that weren't anticipated or budgeted for. Now, let's talk about why this is happening. Minnesota municipalities, like municipalities everywhere, are experiencing genuine budget pressure. Three main factors are driving this. First, wage and benefits costs for public employees have increased. Police officers, firefighters, public works employees, teachers, their salaries have gone up due to inflation and competitive labor markets. These are the largest budget items for most municipalities. A police officer who earned $60,000 5 years ago now earns $68,000, $70,000. That's real cost pressure. Benefits, particularly health insurance and pensions, have also increased. Second, infrastructure maintenance costs have skyrocketed. Road repairs cost more, materials cost more, equipment costs more. Cities that deferred maintenance during the pandemic now face backlogs. The cost to catch up on deferred maintenance is significant, and municipalities are looking at property tax increases to fund it. Third, service demands haven't decreased. If anything, they've increased. Homelessness has increased, requiring more public services. Public safety demands remain high. School populations in some areas have increased. Environmental and climate adaptation requires investment. So municipalities face genuine needs and limited revenue options. Property taxes are the most reliable revenue source municipalities have. So they propose increases. Now, here's what makes the timing particularly problematic. This $1 billion property tax increase is happening at the exact moment when Minnesota housing prices are hitting all-time highs. Remember, property taxes are based on assessed home values. When home values increase, even if tax rates stay the same, property taxes increase because you're paying a percentage of a higher value. So Minnesota homeowners are experiencing a double hit. Home values are up, which means higher assessed values, which means higher property taxes even before considering rate increases, and municipalities are proposing rate increases. This is compounding the pressure on homeowners. A homeowner whose home appreciated 5 to 10% in value in the last year is already seeing property tax increases due to that appreciation. Now add a municipality tax rate increase on top of that, and the total property tax increase could be 8 to 15% or more. Let me give you a concrete example. Let's say you bought a home in the Twin Cities for $400,000 5 years ago. You've been paying property taxes of about $4,000 per year based on that value. Over the last 5 years, your home has appreciated about 6% annually on average due to market conditions and inflation. Your home is now worth approximately $535,000. Your assessed value for property tax purposes has increased accordingly. Even if the municipality doesn't increase the tax rate at all, your property tax bill increases just from the higher assessment. So you're now paying roughly $5,350 in property taxes instead of $4,000. That's already a $1,350 annual increase over 5 years. Now add a 5% municipal tax rate increase on top of that, and your property tax increases even further. You could be paying $5,620 or more. For a homeowner who bought with a fixed-rate mortgage at a certain payment level, expecting property taxes would remain relatively stable. This is a serious problem. The mortgage payment is locked in, but the property taxes just went up significantly. This affects your total housing cost and your monthly budget. Now let's talk about the implications for home values. This is where it gets really interesting economically. Higher property taxes reduce the demand for homes. Here's why. Imagine you're looking at two identical homes. One in a municipality with 1.0% property tax rate, and one in a municipality with 1.2% property tax rate. The home with the lower property tax rate is more attractive because it has lower total housing costs. If municipal property tax rates increase, the home becomes less attractive, which reduces demand, which puts downward pressure on prices. Now the effect isn't immediate or dramatic. Homes don't suddenly drop in value the day after a tax increase is announced. But over time, homes in high-tax jurisdictions appreciate more slowly than homes in low-tax jurisdictions, all else being equal. This is called capitalization. The higher ongoing tax burden gets capitalized into the price. So, if you buy a home in Minneapolis today, anticipating annual property tax increases ahead, you are implicitly paying less for that home, all else being equal, than you would if taxes were going to remain stable. Over a 30-year ownership period, this compounds. Your home appreciates more slowly. Your equity builds more slowly. The wealth-building benefit of homeownership is reduced. For investors and long-term homeowners, this is significant. Which areas are most affected? The Twin Cities metro has the most homes and the most property value. So in absolute dollar terms, the Twin Cities is where most of the $1 billion in property tax increases is concentrated. But as a percentage of property value, some of the most aggressive increases are in outer ring suburbs and exurban areas where municipalities are trying to fund infrastructure for growing communities. Communities like Maple Grove, Plymouth, Chanhaska, and similar expanding suburbs have been particularly aggressive with tax increases because trying to fund infrastructure for population growth. They need new schools, new roads, new utilities, and they're looking at property taxes to fund it. So if you own a home in an expanding suburban area, you might be facing more aggressive tax increases than if you own a home in a stable urban area like Minneapolis proper, though Minneapolis is also proposing significant increases. Greater Minnesota is more mixed. Rochester and Duluth have proposed increases, but some rural areas and smaller towns have proposed more modest increases. The variation is substantial. Now, let's talk about what you can actually do if you are a Minnesota homeowner facing these property tax increases. There are several strategies, some of which are more practical than others. First, challenge your property assessment. Your home's assessed value is used to calculate your property taxes. If you believe your home's assessed value is too high, you can appeal it. This is a legitimate process. Many homeowners successfully appeal their assessments and get them reduced. You will need to argue that the assessed value exceeds the actual market value or that there are factors reducing your home's value that the assessor didn't account for. This requires documentation, comparable sales data, evidence of repairs needed, etc. But if successful, an assessment reduction can offset some of the tax increase. Second, understand your municipality's budget process and engage with it. Most municipalities have public budget hearings. Homeowners can attend, speak, and advocate for fiscal responsibility and tax rate moderation. While individual voices don't always move the needle, collective homeowner pressure can influence decisions. If enough homeowners show up to budget meetings and express concern about tax increases, municipalities take note. Third, look at your mortgage and refinancing options. If you have a mortgage and interest rates decline, you might be able to refinance to a lower rate, reducing your monthly mortgage payment. While this doesn't directly address property taxes, it can offset some of the increased housing costs from higher taxes. So if taxes go up $200 per year, refinancing might save you $150 per month on your mortgage payment. Fourth, consider whether your current home makes sense long-term. If you in a municipality with aggressive property tax increases and you concerned about future tax trajectories, you might consider selling and relocating to a different municipality with more stable tax situations. This is a significant decision and shouldn't be made solely based on tax increases, but it's a factor to weigh. Some Minnesota homeowners are actually considering moving to lower tax jurisdictions because of these increases. Fifth, explore homestead property tax exemptions and other tax relief programs if you qualify. Minnesota offers certain property tax relief for homeowners who meet income thresholds, elderly homeowners, disabled homeowners, and other categories. You might be eligible for programs that reduce your effective tax rate. Researching and applying for these programs can provide real relief. Sixth, if you own rental properties or are considering investment real estate, understand that higher property taxes reduce the cash flow and returns on rental properties. A rental property's profitability is significantly impacted by property taxes. In markets with rising property taxes, landlords often raise rents to offset the increased tax burden. So if you're a renter, higher property taxes for landlords eventually translate to higher rents for you. If you're a landlord, higher property taxes directly reduce your profit. Seventh, politically, advocate for tax policy changes at the state level. While local property taxes are set locally, state policy influences local tax dynamics. Changes to state revenue sharing, changes to how property values are assessed, changes to allowable tax increase rates, these all affect the local property tax burden. Engaging in the political process at the state level, supporting candidates and policies that prioritize fiscal responsibility and tax moderation, can influence the broader environment. Eighth, in your personal financial planning, factor in higher property taxes going forward. If you're buying a home, account for potential property tax increases in your financial modeling. If you're selling, understand that future buyers will be pricing in higher taxes, which affects sale price. Understanding these dynamics helps you make better financial decisions. Now let's talk about the long-term implications for Minnesota's real estate market. Higher property taxes will have several effects. First, homes in high-tax jurisdictions will appreciate more slowly relative to homes in low-tax jurisdictions. Over time, this creates divergence in appreciation rates. A home in a municipality with 2% annual tax increases will underperform a home in a municipality with 0.5% annual tax increases, all else being equal. Second, the attractiveness of Minnesota real estate as an investment declines if tax rates are rising faster than the appreciation rate. Minnesota real estate has been attractive partly because it's been affordable relative to coastal markets and has had stable property values. If property taxes rise while appreciation slows, the risk-return profile of Minnesota real estate changes. Third, younger homebuyers and first-time buyers are most affected by higher property taxes because they have the least financial cushion to absorb increased housing costs. Higher taxes price more people out of homeownership. In the Twin Cities, where housing prices are already at all-time highs, adding property tax increases on top makes entry-level homeownership even less accessible. This could slow market activity among the demographic that normally fuels market growth. Fourth, it creates political tension. As homeowners experience the combined effect of rising home values, increasing assessments, and rising tax rates, frustration grows. This creates pressure on municipalities to moderate tax increases or find alternative revenue sources. Some municipalities might explore efficiency improvements or cost reductions. Others might find alternative revenue sources like development fees or utility fee increases. This dynamic plays out over time. Fifth, it could affect migration patterns. If you're considering moving to Minnesota and you see that property taxes are rising significantly, you might reconsider. If you're a current Minnesota resident considering moving out of state, rising property taxes might push you toward that decision. This affects population growth and economic dynamism. Sixth, long-term, this could create a drag on Minnesota's real estate market relative to competing metros and lower tax states. If you choosing between buying a home in Minnesota with rising property taxes or buying a similar home in a lower tax state, the tax difference becomes a factor in your decision. Over time, this affects relative market dynamics. So what's the net takeaway here? Minnesota homeowners are facing $1 billion in aggregate property tax increases proposed by local governments. The average impact is around $900 per household annually, but it's highly variable based on location and property value. The Twin Cities metro is hit hardest in absolute terms but also in percentage terms. Homeowners should expect property tax bills to rise 5 to 15% over the next 1 to 3 years depending on their municipality. This is happening at a time when Minnesota housing prices are at all-time highs and homeowners are already facing affordability pressure. The combination of rising home values, which increase assessed values, and rising tax rates means total property tax bills could be rising 10 to 20% or more for some homeowners. This affects housing affordability, home values, and market dynamics. Homeowners have options: appeal assessments, engage in the budget process, refinance mortgage, relocate to lower tax areas, explore tax relief programs, and advocate for policy changes. Over the long term, higher property taxes will likely slow appreciation in Minnesota real estate relative to lower tax states, reduce the attractiveness of Minnesota real estate as an investment, and potentially affect migration patterns and population growth. For a state that's been a stable, attractive real estate market, this represents a meaningful shift. If you own a home in Minnesota, understanding these property tax increases and planning accordingly is important. It affects not just this year's budget, but your long-term wealth building through real estate. Subscribe to the channel because we break down market changes, financial implications, and what they mean for your decisions. We don't do hype or fear-mongering. We do data, context, and practical implications. Thanks for watching, and we'll see you in the next one.